Hello, everyone, and welcome to this webinar. Okay, how to go from single family flips to multifamily investing. All right, my name is Augustino. I am with Bulletproof Cashflow. I'm super excited about sharing my knowledge and experience with you here today to help you make that transition. If you're doing fix and flips right now and you're in that world and you really want to switch over to multifamily, I mean, here's the thing. The reason why you started doing what you're doing right now is because you know that there is freedom with doing real estate, right? That is really the reason why you did this. And I can tell you from personal experience, when I was doing the whole single family thing, it was nothing but having a second job. I was working in corporate, I was doing all that, really using that money to throw into real estate. And I can tell you that when I was doing it, it's like, I was buying these houses, I was getting them turned around, I was renting out some of them I was just selling off, and it was a lot of work. It's a lot of work. It makes even more work when you're considering the size of the deals too. Back then, I was doing, 100, maybe $120,000 deals, that kind of thing, smaller deals, right? And that's fine. I'm not knocking it. It's okay. But if you're looking to build truly sustainable income, you want to do wealth, you really want to build something that you can pass on to your kids after you're gone, for instance, right? Maybe you're looking to do that. It's very hard to do with doing fix and flips because the fix and flip still relies on you being there, you being engaged, running the projects, one project at a time, maybe two, maybe three, maybe even 5 projects, 10 projects at a time. It still relies on you to make sure that everything's getting done properly. All right, so it makes for a very difficult way to transition and scale the business, which is what multifamily allows you to do is start building some of that scale that you're looking for, right? But in this training, we're going to be covering the key differences between single family fix and flips and multifamily investing. We're going to talk about why multifamily investing can provide more of that long-term, stable wealth building that we're looking to do, how to properly perform due diligence on multifamily deals, and building your multifamily legacy. Okay. We're also going to talk about the legal considerations that you have to consider in any type of deal and the benefits and challenges of both multifamily and single family flips. Okay. So again, whether you're looking to grow your business or you're just starting out, this training is for you. Okay, it's going to give you a solid foundation to help you make that move from wherever you are to doing big multifamily. So, what qualifies me to even talk about this? Well, I've done a lot of multifamily deals. Okay, I've done in the neighborhood of about $350 million worth of transactions already, not just in multifamily, like acquisitions, right? Mostly B and C type stuff, but I've also done ground up development. We've done adaptive reuse of offices, that kind of thing, right? And we've also done net lease deals as well. So think of like Dollar General, Dollar Tree, think of VCA animal hospitals, stuff like that. So we buy those types of assets in a blind pool fund, and we help people build passive income using that vehicle, right? But one of the lines of businesses that I'm most excited about is helping people get into the real estate game. So if you're looking to really get into this game, go to themultifamilyadvantage.com, click the link, go there, check it out, watch a video, okay? It'll explain a little bit about what we do and how we do it and how we can help you break into the multifamily world. Because honestly, if you're looking to build wealth, got to get around the right people. And it certainly helps if you can get around the right experience to help you get to where you want to go, okay? It's very important that you do that. It's one thing I've learned in the years I've been doing this. That's a real big deal, all right? So let's go ahead and get into this thing, all right? So let's get into the first part here. Multifamily versus fix and flips, okay? So when you're looking at multifamily against fix and flips, it's important to understand the key differences between these two very different strategies, okay? Fix and flips involve purchasing usually some sort of distressed single family type of deal. Okay, you're renovating them and you're selling them for a profit. Simple enough. You're looking for a shorter timeline, usually looking for like, a couple few months to maybe a year if depending on how bad the asset is, right? So it's a very short-term thing, and it revolves you constantly staying on top of that deal to make sure that it performs the way you want it to perform. Okay, and catch any problems there might be, run the contracting crews, compare the pricing between, say, certain assets or certain aspects of the deal too. Make sure you're paying the right price for certain things, right? That stuff exists in multifamily too, but it's a little different, right? Multifamily investments, they focus on acquiring apartment buildings or complexes with a lot of units, right? So you're taking that one asset that we just talked about, but you're spreading it out across a whole lot more in terms of how many assets, or rather how many units are in the deal, right? And the goal here, though, is to generate ongoing rental income long term. So two very different approaches here, okay? Two very different approaches here. With the single family, you're focused on just doing this thing, and it's almost like you're buying a job. In multifamily, you're taking that one asset and you're spreading it across multiple deals, multiple units in that one deal, right? You're spreading your risk across the same asset. Okay, so fix and flips can be a great way to bring in money, okay, but they require a lot of hands-on management, and you carry the risk that, if maybe your ARV is wrong, maybe something happens in a local market, whatever might happen, and you're unable to sell, so now I got to carry it, right? That's not fun. That's not fun at all. With multifamily investing, it requires that you have stable cash flow, but a lot of upfront due diligence. Okay, there's upfront due diligence, ongoing property management. Managing a property is not easy either, okay? But it's a very different skill set. You can rely on a team to help you build that out, right? But really the key benefit of multifamily is scalability. So as your portfolio grows, you get those economies of scale. They kick in, and you're able to reduce your costs and improve that margin of the deal itself. Where fix and flips, it requires starting over every single time with a brand new project. Okay, so that's the key difference there, right? With multifamily, you're adding more to your portfolio. With a fix and flip, you're building it up, you're selling it off, you're doing it again. You're building it up, selling it off, doing it again. And that's, again, not knocking it. Two very different approaches, and you have to define your own personal goal. Like, is that really what you want to do, or are you looking to build something a little more long term? So maybe 10 years from now, instead of just having more fix and flips, maybe you have a whole portfolio of assets, and you're able to get cash flow from that. And listen, it might be fine to do when you're in your 20s, doing these fix and flips all day long. But do you really want to be doing that in your 40s, in your 50s, in your 60s? Do you really want to be doing that stuff? Some people enjoy it, but it's a lot of work, and the work gets harder, right? The work gets harder, right? But listen, overall, multifamily offers better opportunity to build sustainable long-term wealth. That's all, honestly, what it does, okay? If you're able to get that sustainable cash flow, you get that appreciation over time, because people are always looking for multifamily. And I think that as the value of the dollar keeps going down, the dollar keeps getting beat up, people are looking to invest those dollars into hard assets like multifamily. So for those investors who are looking to build that lasting stream of income and scale, multifamily is the smarter play to do that in, right? That's what it is, and again, certainly you can do fix and flip. It's okay, nothing wrong with that. And there's nothing wrong with doing a bunch of single family fix and flips, build a nice nest egg, set it aside, and then invest in your own education. Sure, do it. It's anything you can to build that nest egg so you can redeploy it and learn how to build the skill set that you need to become successful, right? You can certainly do that, okay? So let's get into section 2 here, the due diligence. Now, here's the thing. With due diligence, in both cases, whether you're doing fix and flip, whether you're doing multifamily, due diligence is extremely important. This is the most critical asset critical aspect of doing these deals, okay? What due diligence means is, are you doing the homework on the deal to understand all the nuances, all the problems, all the issues with the asset that you're buying, so you have a clear picture of the work that's going to be required to fix it up? That's what you want to know. Due diligence is the most important aspect of the deal. And during the due diligence phase, there's multiple phases when in putting any type of these deals together, whether it's a fix and flip, whether it's multifamily. Generally, it goes, there's some sort of length of time for due diligence, length of time for financing, and then you close. That's it, right? So it's like there's LOI, due diligence, financing, close. And usually it's, might be like LOI might be a couple few weeks to negotiate all those points. Due diligence might be, 30, 45 days. The purchasing might be another 30, 45 days, and of course you close right afterwards. This due diligence period right here is the highest length of time that you have for any type of leverage when you're putting a deal together. And what I mean by that is that if, let's say, you're doing your due diligence and you discover that there is a problem with the sewage line, okay, that the seller had no idea about, the broker, the real estate agent had no idea about, but you discover because you decide to scope out the sewage line. All right, that's a good idea to do that, by the way. Scope out all the sewage lines to make sure everything's nice and clear. That is the time that you can ask for a credit or some sort of repair or something along those lines. Because if they honestly didn't know about it, then that's when you can fix it. Once you're past due diligence, your money goes hard, non-refundable. All your leverage is gone, right? So it doesn't happen before LOI because you didn't have a purchase agreement yet. So you're not able to do all these sorts of things. You want to do your due diligence. So you have to carefully evaluate this. Okay, so for fix and flips, you need to closely look at the purchase price. You got to run comps to determine the accurate ARV, the after repair value, and then you have to build in those conservative estimates of what's going to take to fix the asset too, right? And again, you cannot, knowing that it's a fix and flip, you can't take all this stuff to the seller and say, well, it's going to take me this much money to fix it. They don't care about that, right? They know what they have, and they know what you got to know what you're doing too. But this is the part that you got to realize, is it worth doing the deal, right? So that means you have to scope out all the repairs. You got to inspect the foundation, the roof, the siding, the electrical, the plumbing, HVAC, all that fun stuff. Okay, you have to get multiple contractor bids as well. Okay, when it comes to the sewage lines and foundation, especially those two things are some of the most expensive aspects of the property. So make sure that you spend a little bit of extra time and care figuring that stuff out. Okay, then you have to do your cost of repairs. Okay, how much is it going to cost to fix all these things? Then you have to do the research, prices for flooring, cabinets, fixtures. You have to budget for all the contingencies. And of course, labor, labor costs have jumped up tremendously. So each trade has their own prevailing wage, so you have to budget that in. So then of course, if you have to hire a PM, a project manager, or you're going to do it yourself, you budget that in. But then comes a timeline of how long it's going to take to put all this stuff together. Okay. The longer it takes, the more expensive it becomes. So you want to be sure that when you conduct your due diligence, the only time I like surprises is for my birthday. All right. You don't want to have surprises when you're doing a deal. That's the last thing you want. So what does that mean? That means building in enough time in your transition time to, once you close the asset, to do all the things that we just talked about here, and then give enough time to sell it. Okay. You're going to have to deal with inspections. You're going to have to deal with the city, all the different kinds of stuff. Okay, so always assume the worst case scenario. Okay, don't assume the best case scenario. Everything's going to go perfectly. Very rarely does it ever go perfectly. Okay, so you have to be sure, again, do all the inspections, do all the work properly with licensed folks that are building this thing out for you, and that way you can be assured that you have everything will pass muster when you go to sell the asset, usually at retail, right? Because that's what that ARV number is. And what that means is someone going on Zillow looking for a brand new rehabbed home. You can't, this is something you can't just slap together. You got to put together some nice quality workmanship in the deal, in the single family. Okay. So that means finding a good set of contractors, which, by the way, if you go to guide2contractors.com, there's a free ebook that I wrote up there, and go ahead and grab it. Okay. It's totally free, like I said, and it shows you how to vet out contractors. Okay. It's very, very important that you find the right people for the right job. And you're going to have multiple people for the different jobs in doing the deal. Okay. For sure. So you'll never hire, hopefully you'll never hire one person to do everything. You won't have to do that. Have some redundancy in that regard. A big part of this is the financing. Okay. So talk to many financing folks, many brokers, many lenders to find the best combination of rates and terms for the deal. Okay. So what that means, again, with hard money, which is usually what you're talking about in these small single family assets, these fix and flips, hard money means very, very expensive money. You have to make sure that the juice is worth the squeeze. If you're going to pay 15% interest on these types of deals, you better make sure that the deal's worth doing, right? So I recommend either downloading or creating a comprehensive rehab list. That way you can write down and project all your expenses and buffer at least 10% for any cost overruns. Now, here's the difference though. With that and multifamily, the same thing basically takes place. Or you still have those key due diligence items. Usually there's some sort of element, at least in the assets that we do anyway, the C-class type of assets, okay? If you don't know what C-class is, I go at length. If you go to the Bulletproof Cash Flow YouTube channel, I have 700 videos that talk about various aspects of multifamily, and what we're talking about is A, B, C, and D. These are the grades of the different type of deals. Your C-class is workforce housing. Okay, this is the people that make America move. Your mechanics, your people that work in restaurant industry, for instance, they all live in C-class assets, C or B. Okay, and that's the stuff that we buy. Okay, in those types of scenarios, we do the same sort of due diligence, but we're also looking at the market conditions. Okay, so we're looking at demand drivers, we're looking at population growth, we're looking at job creation, we're looking at a lot of different other data points, aside from the individual unit turns. And then when we're looking at the unit turns, we're not just looking at one single family home. We're looking at how do you replace flooring in 50 units or 100 units at a time, right? How do you go around and paint all 100 units? What sort of kitchen upgrades we have to make across the board? That's the kind of stuff that we're doing, right? So the numbers get much larger. Okay? So we're looking at this population growth, job creation, all those sorts of also sort of economic drivers. We're looking at the rent roll. We're looking at the analysis of the rent roll and the T12. Okay, we want to understand who's living there. Are they paying? Is everything going smoothly? We're looking for stability, and we're looking at any type of gaps when it comes to the rents to see if there's any way to move the rent up. Okay, maybe the current owner, they've already paid the asset off a long time ago, and they're just, they're okay. Even though the rents are super low, they're still making a lot of money. And because of that, they haven't really improved the property all that much, but they don't care. The property was paid off 10, 15, 20 years ago, and they're just sitting on a bunch of cash, and they're just cash flowing. That's the perfect scenario to get in there, take it off their hands, and make it better. Okay, we've done that plenty of times. Okay. We're also doing a deep analysis on all the financials. Okay, so usually we're looking back at least 2 years at income and expenses. We're looking at some of the improvements that were done. The lender's going to want to see what sort of improvements were done previously, what we plan on doing into the future, which also goes into trying to predict the future performance and what the upside is. The lender wants to know what the upside is of the deal. Okay. And of course, the physical inspection. Like I mentioned before, when we're going through and we're looking at the different units, what sort of things are we going to do to make the units better, to make it a great place for people to live? We also use a detailed checklist to go through all the units, what sort of individual things need to be fixed or replaced or upgraded at the property. Okay. The big part here is, after all this, is the legal review. Okay, so in both cases, you're making sure that the title's nice and clean. There's everything. There's no issues with the title. Okay, so a good title company will do this for you. Okay, I've heard numerous stories about how after the deal was closed, there ended up being a lien on it that no one caught. So to that end, make sure you're working with some smart folks on your team, and we'll get into that here in a little bit, to put together, to make sure that everything's getting inspected on the title, so you know that the asset that you're getting is going to be in, nice clean title, no issues. You don't have to come out of pocket to clean out a big mess down the road. Okay. Of course, you're also looking at the taxes as well. Okay, it's legal and government type scenarios, right? You have to make sure that different places charge taxes in different ways. So make sure you have a clear understanding of what that looks like. Ask your real estate attorney, and they may direct you to like a tax attorney, and you can ask them, hey, what do you think it's going to, how tax is going to look on when I close this deal? Again, I've heard many stories about how after they closed, they suddenly get slapped with a tax bill that nobody had any idea about. Okay, depends on the municipality. Here in Ohio, for instance, if you closed a deal in, say, June, the state would come after you down the road. The state will come after you for all the taxes from January all the way to June, even though you didn't even own it back then. They were doing all that stuff before. It's like it's a cash grab. That's what it is. Let's just call it what it is, right? And they stuck you, the new owner, with that bill. Of course, the previous guy is not going to pay it. Why would he do that? So again, whether you're buying multifamily or a single family flip, make sure to protect yourself against those types of scenarios. Okay, but regardless, in both cases, they require a lot of due diligence up front to ensure you have accurate numbers and avoid costly surprises. Okay, avoid the surprises by getting a clear understanding of what it is that you're getting into. Okay, at the end of the day, you're looking to get a clear, comprehensive picture of the property and identify any problems up front. And you're doing it during that due diligence phase I told you about. So before you move to purchase, the purchasing phase, you want to understand all of it up front. What are you getting? Okay. Now, it's equally important to form those relationships with brokers who can not only find you the deal and help you avoid overpaying. These brokers and these agents will help you unload the property down the road. All right, that's why you want to try to talk to as many of these people as you can, right? Because here's the thing: if you get connected up with a great agent or a great broker that is not only plugged in just on the investor side, say investors like us, right? But they also work the retail side, and they're excellent at the retail side. So you may go ahead and maybe it is a fix and flip. Again, nothing against fix and flip, you're just calling it what it is. But you go ahead and you fix this asset up, you make it look great. Maybe that same agent that sold you the place says, hey, you know what? I know a family that's looking to move into this area. Maybe after you're done, I can just flip it over to them and see if they'll buy it. It can happen. It has happened, right? And that gives you an opportunity to keep building those relationships. Okay, the relationships in real estate are everything. So build as many as you can. Okay. But aside from getting and liquidating deals, to these folks can provide you access to properties that are not listed, pocket listings. Okay, that's what they're called. The pocket listings are, whether it's a single family or a multifamily or whatever type of deal it is, the ones that are plugged into the local market, they're the ones that'll get you the deal. If you start transacting with those people and you do what you say you're going to do and have integrity while doing it, chances are you'll get the deal. Okay, that's what you're looking for. That's what you're looking for. But I love relying on brokers. Okay, keep your eyes open for deals too on your own, especially with the fix and flips, right? So with fix and flips, it's a little different. You're doing a lot of driving for dollars, a lot of bird dogs out there. You're interacting with a lot of wholesalers as well, right? Because the wholesalers are hitting the phones, trying to find those deals as well. Wholesalers are a great way to find deals. I mean, I know that agents are probably cringing for me saying it out loud, but they're hitting the phones too, right? I mean, anywhere where the deal is, you got to go get it where the deal is, right? Right. But ultimately, they have those off-market opportunities. So it's you're trying to find those hidden gems is what you're trying to do. Okay. All right. So section 3, building your team. Now, I talk about this a lot. Team building. I talk about this in our masterminds all the time, okay? If you're looking to build a team, there's many things to consider here, and whether you're doing multifamily or fix and flip. Multifamily certainly requires a very different type of team, okay? It just does. First and foremost, you need a property manager. So that's in multifamily, the first person you're hiring is a property manager. So the thing is, though, especially on larger multifamily, you're assuming you're not going to be or managing the asset. You want to try to find an experienced local property management company that has a great reputation of leasing up assets, good operations, and they know what they're doing. Okay, you can also look at the National Rental Association to see if they're members. The better property management companies will be members of those, okay, those types of groups. But the better property management companies will tend to be very active in the association. More importantly, though, when it comes to multifamily, these folks need to have a good reputation with the local brokers. It's better when the property manager has a positive how should I say, reputation, a positive reputation, and if you're aligned with that property manager, and even if you're just starting out, whether you've done no deals at all, you can leverage their experience, you can leverage their reputation when you're talking to the property, to the brokers, to the agents. And they'll come off you'll come off as a pro because you know what you're doing. So it's going to take a little bit of work, okay? That leads me to real estate agents or brokers, okay? When you're trying to find these sorts of folks, okay, you can find these people on websites like LoopNet or Crexy or one of these types of websites for commercial, right? But also for residential, you go to Zillow and you can look to see who's got a lot of listings, who's active, who's engaged with the local market, okay? That's what you want to do. You want to try to find some of those people, right? Attend the local RIAs, real estate meetups, things like that, and try to find people that are networking with these types of brokers that primarily focus with investors, okay? It'd be nice to find real estate agents and brokers that work with investors in state, out of state, in the city, out of the city, those types of active folks, okay? There's also another ebook that I have, guide2brokers.com. Go ahead, check it out, download that ebook, all right? It's a great resource for you to learn how to communicate and reach out to these sorts of people. Okay, they'll really help you out there. So, what else should you look for? Contractor. Now, contractor is going to be very, very important, especially in the fix and flip side. So, like I said before, I started talking about the property manager first, if you're just talking multifamily. In the world of fix and flips, you're trying to find the contractor first. The contractor becomes the number one person, not the property manager, okay? So in the world of multifamily, the contractor is actually third, believe it or not, right? In fix and flips, it's the first one you're trying to find, okay? You have to go through a lot of contractors for this one, okay? It'd be nice to find a contractor who's experienced with renovation, experienced with finding the best pricing on flooring, paint, all those sorts of things. Not just going to Home Depot. Maybe there's other places where they sell clearance items that usually every large city has a place like that. And if they know where to find that stuff, great. You should definitely bring them on. And of course, conceivably these contractors have plumbers, they have flooring guys, they have paint guys, they have roofers, they have a whole network of other types of tradespeople behind them to help you get through the whole project. But vet them out thoroughly, okay? Like I said before, go to that guide to contractors.com, download the ebook, okay? It talks about everything from vetting them out to looking to see who they're also associated with, and make sure you're trying to get the best folks you can for the project that you're working on, okay? That's very, very important. What else do you need? In both cases, in both multifamily and fix and flips, you need a good attorney, okay? A good, competent legal advice to navigate the regulations and protect your interests, okay? So depending on the types of deals you're doing, get a good real estate attorney. If you're doing a bigger multifamily deal and you're syndicating it, it's a securities attorney for that, okay? Two different types of deals. Make sure you get an accountant. You need an insurance agent. You need a lender, of course. Like I said, in both cases, the two different types of lenders, okay? I like to know where the money's coming from when I'm putting a deal together. In the case of a fix and flip, you're looking more than likely a hard money lender to get into the deal, or you're paying cash for it, or you're using your own money. But if you're using hard money, usually you're going to find those folks at the RIA. The RIA is the place where a lot of the hard money guys are. When I say hard money, you're talking 12, 13, 14, 15% interest. It's only meant as a short-term solution. If you don't know what you're doing with hard money, maybe take on a partner who's experienced so you can learn the ropes. It's okay to give it 50% of the deal. It's, in my opinion, you're learning from someone who's done it, okay? It's very important that you do that, because if otherwise you can end up in a whole heap of trouble. In multifamily, it's a little different, okay? You can certainly do the same thing with hard money. You can certainly do all that and get in and fix the asset, sure. But the types of deals that we do, lenders love these deals. They do. They just love these types of deals. And the lender is part of the team. Like they believe me, on a $120,000 deal, no one cares. The lender doesn't care, right? When you're doing a $100 million deal, all the lenders are watching you. All of them are watching you. So I can assure you of that, all right? Or even a $10 million deal. All the lenders care a whole lot more, right? So they want to know how your team is set up. Because here's the thing, your team will make or break your success. They know that, and I'm telling you, it's a big part of it, okay? So vet out each member of your team thoroughly. Ask the right questions, check the reviews, ask for references. If your gut tells you something that you don't feel weird about them, it's not going to get any better. Try to find someone else, okay? Sometimes your gut will tell you, okay? So trust your gut. That's what I have to say about that. But take the time to build relationships with these people, because hopefully it's not just going to be a one-off. You know, you're looking to build a relationship that'll last years. I've built relationships with many of the partners in my staff, in my company, and I've worked with these guys for a very, very, very long time. You know, and it's a trust that's built over years. So you want to do the same sort of thing, but. In how you do that, you know, you have open lines of communication, you schedule regular meetings with them, communicate openly. And I think that when you do that, you're able to get a good, solid foundation of experts that are going to help you succeed, okay? That's a big part of doing this, okay? So, section 4, legal considerations. Now, there's real big, important aspects when you're thinking about legal between single family and multifamily, okay? Single families have more consumer protections, okay, because it's considered like a consumer class transaction. Multifamily, at least 5 units or more, is considered commercial, okay? There's very few disclosures, very few buyer protections. It's a little more wide open, okay? So with the smaller single family transactions, like 1 to 4 units, there's a greater responsibility of due diligence to uncover any issues prior to the purchase. But this is why when I said earlier about making sure you have licensed contractors, don't get into any trouble, keep your nose clean, because if something comes up, The last thing I want to do is like deal with all that all over again. You don't want to do that, so make sure that the workmanship is on point and strong, okay? Multifamily is a little different. And I'm not saying, you want to try to squirrel away and hide from people. That's not the point here, right? It's commercial, it's a whole different animal than fix and flip, is all I'm saying. It requires a very different level of sophistication with those bigger deals, okay? So I recommend working very closely with a knowledgeable real estate attorney on any multifamily acquisition to ensure you avoid the costly mistakes because you don't have the experience or the oversight, okay? That's a big part of it, okay? And usually, it doesn't necessarily mean going to the biggest and baddest firm in town. It doesn't always mean that. It could just mean you have a good, solid attorney that works. Maybe they're a solo practitioner. Maybe they have their own shop and they help people get into the real estate game on the legal side too. Great. What matters is, do they know their stuff? You want to try to find the best ones and interview them the same way you would anyone else, the same way you interview the contractors. Okay, so that's a real big part of it. Okay, so let's go into section 5 here: the pros and cons of multifamily and fix and flip. So the trade-offs, multifamily pros. You have to, if you do it right, you get nice steady cash flow. You get that built-in stability from having multiple units because, like I said, you're spreading that risk across multiple assets, and that's lowering your risk because you have diversification. You're able to get those economies of scale because you're able to buy with one transaction more units, right? As opposed to single family, you're buying one transaction at a time and you're just flipping them. With multifamily, you're buying 10, 15, 20, 30, 100, 300 units at a time, and you're just doing one transaction to buy 300 units, which I've done, right? You're able to scale it up fairly quickly, okay? You also get the depreciation and long-term wealth, okay? Because here's the thing, with multifamily, there's always going to be a need for multifamily. There's always someone out there that wants to buy multifamily deals, and because of that, the lending is always going to be there, the buyers are always going to be there. Is it going to be at the price you want? Of course not. No, the markets change. They expand and they contract. But the thing is, though, there's always demand for it. Always demand, right? So that's a very big part of it. The cons of multifamily: more upfront due diligence, a great deal of more time, and it does cost more too, right? You need a way different team when you're doing these types of deals, okay? You need an advanced team in place to do it. You also have to have ongoing property management that knows what they're doing, and preferably someone that is local and very familiar with what's going on in the local market. Preferably ones that know the mayor, they know the judge, they know the city well, they know everything about what's going on in that market, right? That's what I would recommend strongly when you are installing property management at an asset that you are buying, okay? So like I said, if you go to themultifamilyadvantage.com, there's a mastermind that we do. It's a 50-week mastermind. You should definitely check it out. If you're looking to get into multifamily, go ahead and check it out and set a time with my team, and we can help you get into the multifamily game if you're not there already, okay? If you're looking to expand your business, multifamilyaccelerator.com, we show you how to do that. If you're looking to do syndication, you want to start raising capital, you want to start really blowing up your multifamily game, that's what we have for you, all right? So check out those two websites, all right? Now, let's get into the fix and flips pros. So with fix and flip, you get those quick profits when it's successfully done, okay? And what I mean by quick is, 4 to 6 months is reasonable if you're in a good strong market and you buy the asset properly and you do the right upgrades to sell the asset, okay? You get that creative freedom for doing renovations. Hopefully you don't overdo it, right? But you can start small and test out your approach to see how you do, okay? The cons, though, is it's a feast or famine, when it comes to income. That's probably one of the biggest things. That's why many of these guys have multiple fix and flips going at the same time. These days, the labor is extremely expensive and it's tough to find people as well, right? It's very, very hard to find individuals to keep the asset moving, because again, time is what you're trying to compress in these fix and flip deals. And it's very hard to scale these types of deals too. It's like, it's because each deal you're going in, you're putting a whole lot of work, you're selling it off, taking the cash, and doing it all over again. So you're all you're doing is creating another job, is all you're doing, right? And again, I'm not knocking it. That's okay. If that's what you want to do, that's fine. But it's two very different things than doing that in multifamily, because the lack of ongoing income and the lack of wealth growth it's just not there. It's not there with that. So you have to evaluate both strategies, whether it's multifamily investing and you want to get the scale and you want to grow efficiently and diversify, versus doing the fix and flip. Okay, the fix and flip requires a whole lot more work and constant work for longer periods of time. And it just depends on what you want to do. Depends on what you want to do. Okay, so like I said, we covered a lot here today. Okay, the key takeaways, in my opinion, multifamily provides the stable cash flow, and it's a long-term strategy. So in both cases, you're still doing due diligence. Okay, multifamily can be way more due diligence intensive, right? But the thing is, though, is that when you're doing your due diligence, there are set people that can help you do that kind of stuff. So that means aligning with the right pros and the specialists to make sure that due diligence is conducted properly in both cases. But when it comes to the bigger deals, there's going to be a lot more eyes on it, rather than doing a fix and flip where it's mostly going to be just you and a contractor, right? Always understand the legal differences, especially as it compares to single family, just because, again, it's a consumer-based issue, consumer-based asset, right? So it's going to have different types of rules associated with it. And you know what? When you're looking at those deals, consider maybe putting together like a pros and cons of the deal itself, not just the deal, but also the overall strategy you wish to employ overall. Some folks, they're happy doing fix and flip, and again, that's all right. They're happy doing wholesale, and that's all right too. I'm not mad at it, right? The thing is that it depends on what you plan on doing long term. What do you foresee yourself in the next 5, 10, 15 years? What do you really want to see yourself doing, right? And if the intent is to get into real estate and buy a job, then fix and flip is the way to go. Wholesaling, sure, go ahead, do that. If you're looking to really scale and grow and get that time freedom, ultimately it's what we want. We want time freedom, right? The freedom to do what you want when you want to do it, without having to worry about your overall cash flow. Multifamily is where it's at. It just is, right? And the bigger the deal is, the easier it becomes, because you're able to afford more experts, more eyes, more hands to help keep that unit in check and make it and expand it and grow it and get you that cash flow that you're looking for, okay? Anyway, like I said, if you're looking to get into the small multifamily space, okay, themultifamilyadvantage.com. We help people get started in multifamily. If you're already in multifamily and you want to blow it up, Multifamily Accelerator, okay? Both of them are a 50-week mastermind, okay? Very robust, and we give you everything you need for both of these programs, both these masterminds, to be a beast at the multifamily game. Okay, so I hope you find this webinar useful. Okay, if you have any questions, comments, go ahead and drop into the comment section. Okay, even this, if this is on YouTube, you're watching this on YouTube, go ahead, put it on there, and someone will reach out to you. And always looking to interact and talk to folks out there. So by all means, hit me up. All right, we're at bulletproofcashflow.com as well. All right, that's all I got for you today. I will see you in the next one. All right, take care.